Welcome. You're listening to The Best of Investing. I'm your host, Edward Brown, along with my co-host, Nam Phan of Pacific Private Money. Mark Hanf is off today. Our phone number is 888-912-1190. Use that number to answer the trivia questions for a 5-pack tanning certificate given away during the show. And that certificate's not sponsored by the radio station, but by Tan Bella Tanning Salon with 2 locations in San Francisco and 1 in Marin. Boy, they've been a sponsor now for, gosh, at least 3 years now, I got to think. Pretty cool.
I feel like it's been longer than 3 years.
It yeah, now that COVID's been sort of by the wayside, I guess people are going and getting their tan on again, getting ready for the sun. So check them out at tanbella.com. Today's trivia theme is.
I would use it, but I tan so quickly. So
yeah,
just walking outside for a couple hours.
Yeah. Today's trivia theme is miscellaneous trivia. And by the way, those tanning certificates are worth over $100. So definitely you want to stay tuned for the trivia questions. All right, so we don't have a guest today, but I do have a few interesting things that I was listening to the news yesterday. So this was, we're recording the show on Thursday, so this would have been Wednesday. I was listening to this. So Geico Insurance got sued and actually lost so far before any appeal, $5.2 million judgment. And here's what happened. There was a woman, and I don't know if she was a lady of the evening or just, a girlfriend or just whatever, but apparently she was having some romantic interludes with a gentleman in his car, and she got an STD. And so she basically said, hey, I got injured in this guy's car. So she sued the insurance company. And I don't know all the ins and outs of the case, how bad the STD is, any of that kind of stuff. But just the idea that Geico is being sued and lost $5 million. And I'm thinking, I mean, it'd be one thing if like you're having fun in the car and somehow, the car caves in for something with the car. But how do they get sued because of being injured by something like that?
I mean, how many people, wow. That's interesting. There's got to be more to the story than that.
There's got to be. I mean, it kind of reminds me when remember how I think it was McDonald's. They got sued because some lady had coffee in her lap and she got hurt because of it. And at first, we all are going, "Oh my gosh, that is like the stupidest lawsuit." The behind the scenes situation apparently though was that McDonald's was making their coffee way too hot, and people thought it was because they were using old grounds or something. And it's like that's one way to sort of make your coffee last longer, the grounds or something. Trying to save money. And apparently they were warned, like, listen, you've got to put the temperature down because this is not forgetting the fact that somebody's going to put it in their lap. It was probably burning people as they're drinking it, and they just kind of ignored it apparently. And so when this lady had a lap, it burned her. But still, you kind of look and go, wait a minute. It's one thing if you burn your lips and want to sue because of that, but because it happens in your legs, that's kind of
okay. So that's good backstory for that. So you got to wonder if what's going on. But that's interesting.
Yeah, I mean, yes, it maybe.
So have you been in?
The car was so steamy or something that it cost. I don't know.
There you go.
Okay. Moving on here, Twitter. So Elon, he's kind of backed off a little bit apparently, but he's still kind of looking at Twitter with regard to these potential fake accounts. And if that's the case, he'd want to lower the price. And so, to get a better deal. It sort of reminds me of like when people sell storage facilities, sometimes the sellers, like even if they have, let's say a 40% vacancy, they'll try to fake out the buyer by buying a bunch of locks and just putting them on empty locks. And then say, well, look at all these are rented. You see what I mean? So it's
wow.
Because potentially with Twitter, there's the accusation, we'll call it, that 20 to 40% of accounts are, inactive, fake, or whatever. And
bots,
bots, and
so what I've heard lately about that is that Twitter is allowing or reporting or opening up the reporting to Elon and his team,
Okay.
so that he can see, I guess, what, how, I don't know how you still, like, how do you verify an account is fake?
I don't know. I mean, I started a Twitter account, but I've never used it. So it's a real account, but there's no activity
Yeah.
on it. And apparently, I mean, this really opens up another can of worms, because potentially, let's say there were like really fake accounts, like the real fake ones. Potentially the Attorney General might get involved for false advertising, right? Because can you imagine if you're Twitter, and if you have a bunch of fake accounts and you go out and purport that you have all this in order to get dollars from people. I mean,
Yeah.
that could be a problem. And then what about lawsuits by shareholders? And then other people are saying Elon, the only reason he's doing this is just to like just try to get a lower price.
Right. Yeah. And so the Twitter salespeople would be going out there and promoting, false exposure. Obviously, maybe they're not privy to the real numbers, but yeah, that's going to be, if Elon potentially backs out, that's going to drive their price down. But not on top of that, it's going to drive their price down for the fact that they don't have the audience that they think they have. So
yes,
wow,
exactly, yeah. So it's very, very, very interesting. We'll see how this all unfolds. Okay, we're going to cut to our first commercial break here. And before we do, we want to make a mention for Mountain Mike's Pizza in Santa Fe. Pizza the way it ought to be. Love that pizza. All right, here's our first trivia question. And again, the first caller with the correct answer is going to win that tanning certificate, which is worth over $100. Let's see here. Here's the question. What was the complete name of the Toga Party band from the movie Animal House? So if you remember, they throw a big toga party and they have a band there. What was the full name of the Toga Party band from the movie Animal House? Call 888-912-1190. The first caller with the correct answer is going to win that tanning certificate. Stay with us. The Best of Investing will be right back. Welcome back to the Best of Investing. Edward Brown here, along with Nam Vaughn of Pacific Private Money. Our first trivia question: what was the complete name of the Toga Party band from the movie Animal House? You remember?
I don't remember.
Otis Day and the Nights. Yeah, remember that? Okay. Hey, one other quick thing here. Have you heard the term shrinkflation?
No.
Okay.
No, I've heard of
so what that is, okay, so if you go shopping now, and I've actually seen this experience. So I go to Safeway a lot, and I like their cans of Soleil. They're different kinds.
The drink.
Yeah, exactly.
Yeah.
And they used to sell the 12 packs for between $3 and $3.50. Okay. You have to pay the same amount now for an 8-pack. So what they're doing, that's how they're basically passing the inflation on, is they're saying, oh, we're not raising our prices. We're just going to give you less. And Honey Bunches of Oats has done that already with their cereal. So a family size, you'll notice, is there's a lot more air in it than oats.
Oh, really?
Yeah.
Okay.
So notice
they retitled it Honey Bunches of Oat.
Yeah. or not honey bunches, but honey few of oats. Yeah. And listen, I love that cereal, so I'm not picking on the cereal, but I would not be surprised if other potato chips apparently are doing the same thing. And
I think they've been doing that for years, because I'll open a bag of potato chips and you open it and all this air comes out, and then you look at it like small amount at the bottom.
When they say air is free, nobody's ever opened a box of potato chips before.
Yeah. The only one that you can't do that with is Pringles, unless they shrunk the size of the canister, but it's always full to the top, right?
Yes, or maybe what they do is shrink the actual Pringle.
Yeah,
the size of the Pringle. Yeah, you can do that. But that's true. You're right. Pringles are always at the top. Oh, you're making me hungry, man. It's not that. Okay. All right. Well, let's move on. So Pacific Private Money, you guys are extremely busy. In fact, I'm so pleased that you're able to do the radio show today, because I know that you're burning the midnight oil.
Yeah, we've been, gosh, it's great to be back on. I really enjoyed and actually missed doing the show, because it's just one of those kind of diversions that allow us to kind of step back from the day-to-day grind.
Oh, yeah.
No, it's been great. I mean, it's been busy. It's things are stressful. It's busy, but it's a good problem to have, considering, what we're seeing generally in the conventional mortgage market. And, we're busier than ever. We already achieved what we did all of last year in terms of, loan origination. So, we expect to have grown over twice, the volume that we did last year by the end of the year. So for us, things aren't slowing down at all. And,
good.
That kind of, counters what the, media says about housing.
Yeah.
Certainly there is some contraction in the housing market in terms of, sales activity, going down because of higher interest rates, inflation, what have you. But there's still an inventory shortage out there for those people who want to purchase. And, rates have stabilized, but we're still seeing the same volume of, for us, bridge loan business, people needing a loan to buy their next home before they sold their current home. And something I'll talk a little bit about later is the other kinds of business that we're doing. Obviously, all real estate and real estate lending related, but the alternative lending space has not slowed down. It's accelerated because there's a need for it across different borrower types, including people who are buying a home for their to live in. There's a lot of investor activity going on. So love to share with our listeners kind of macro view of real estate transaction activity and who's borrowing from us and why are they borrowing it. I think that'll be great to share with our listeners, in addition to what we always talk about, which are our bridge loans. But I can tell you, at Pacific Private Money, we haven't slowed down. We have been on a hiring tear, continuing to need to hire people. And, with that, it's training and just the day-to-day operations of, accommodating our borrowers and making sure that we close on time on the loans we're doing. So, but just bridge loan activity, the average loan size is still going up. We're actually pretty, the slowdown isn't necessarily a bad thing for us. And here's why. So last year at this time when we were making bridge loans, people needed them because they were making offers on homes that, had multiple offers on them. And to win, you had to be all cash, or you had to make an offer that did not have a sale contingency, meaning an offer that didn't require you to sell your home first in order to fund the purchase of your new home. And so our bridge loan solves that problem. But the problem for us is people could sell their home so quickly after they got a bridge loan that we'd often get paid off in, average of 90 days, sometimes, 30 days. So as a lender, to have a loan out for only 30 days or 90 days, you're not making a whole lot on the interest, right? And so in a more balanced market, as a seller's market becomes more of a balanced market and ultimately a buyer's market, if it goes in that direction, then it takes a little bit longer for sellers to sell their home. And so where maybe it took, a month, last year, maybe it starts taking 2 or 3 or 4 months. That's actually not a bad thing for us because, then our bridge loans we keep for, 3, 4, 5, 6, 7 months. Borrowers have a year to pay off our bridge loan. And so it would be better for us if these bridge loans held a little bit longer. So this changing market actually kind of benefits us in that way, even if we don't do as many bridge loans, which we're not seeing. We're still doing more bridge loans than we did last year. But having these bridge loans, stay on our books a little bit longer is not a bad thing. So,
gotcha.
So we're just going to continue to do those. And later on, we'll talk about the other types of loans we're doing across the country, not just in California.
All right, let's cut to our second commercial break. And also when we come back, we have an email question for you about house price drops potential. All right, here's our second trivia question. What was the first animated feature nominated for a Best Picture Oscar? What was the first animated feature nominated for a Best Picture Oscar? All right, that's our trivia question. Call 888-912-1190. First caller with the correct answer wins that tanning certificate. You may have to ask your daughter. She'll know. Probably. Well, she might know. All right. Again, one more time, I'll ask the question. What was the first animated feature nominated for a Best Picture Oscar? All right. Stay with us. You're listening to The Best of Investing. Don't touch that dial. We're going to be right back. Welcome back to The Best of Investing. I'm Edward Brown along with Nam Phan. Our second trivia question. What was the first animated feature nominated for a Best Picture Oscar?
It wasn't Toy Story, was it?
No, that would have been my guess. That would have been a good guess. This was before, I think it was before Toy Story. I think it was before Toy Story. No, it was probably after. Beauty and the Beast.
Oh, really?
Yeah. Okay. Did that come afterward?
Before. I think that was before Toy Story.
Was that before? Yeah, maybe you're right. I can't remember now. I'd have to go back to look that up. All right. Okay, here's an email that comes in for you that says, how far would house prices have to drop in order for you to be concerned as a lender? That's a pretty good question.
Yeah. So as a lender, at Pacific Private Money, we lend on real estate and we do follow real estate prices closely. In general, the loans we make are short term, so that'll help answer that question a little bit. Okay. But typically as a lender, what is your protection? Your protection is certainly just the collateral, which is the property itself. But it's only protection if there's enough equity to cover your loan, so that if you had to take a property back, you could sell it or dispose of it and at a price that covers your loan and any other costs. And those costs could be legal costs. They could be costs to fix up the property and prepare for sale, cover any, default interest that the borrower may have accumulated but not been able to pay, because you have investors oftentimes as a lender that you have to pay back as well. And to cover just the cost of managing, for instance, a foreclosure. So how do you buffer against that? You can make or require that a borrower bring in a down payment, and a sizable down payment. Yeah. So Pacific Private Money does that, where we require borrowers bring in 30%. It can be cash at close that they're providing. If they're buying a home, for instance, they put 30% down, or we can use collateral and other real estate that they own as equity. That protects us, so that in the event we have to foreclose on our property, that 30% cushion allows us to be whole, or sometimes actually make a profit if we actually have to foreclose and sell, which we've done. So we have to be concerned if prices drop so much that equity is eroded down from 30% to zero or more, because then our loan amount is in jeopardy of getting paid back in full if for instance home prices drop 60% or 40% and we made a loan at 70% loan to value. But how do we mitigate that? Well, we can tighten up our lending guidelines to say, we're seeing home values drop, so we're going to lower or increase the amount that we require borrowers to bring in from 30 to maybe 35%. We may just say no to a loan. So generally your profits are made at the time you make the loan, and not at the time the loan is paid off. Because you have to price it right, and you have to take into consideration, market conditions. Other ways to mitigate that are to, just the longer you're in a loan, the longer it increases the chances of something going wrong.
Okay.
For instance, home values in general dropping. The longer you wait, closer you'll get to a market cycle, right? Or the increased likelihood that something happens to the borrower, they lose their job, they're unable to make payments. Our loans are typically, anywhere from 6 to 18, 24 months. We have longer term loans in there, but in general, the majority of loans we originate were paid off pretty quickly within 12 to 18 months. And our bridge loans even less. And when it's that short of a hold period for any particular loan, your exposure on that loan to the market is much less than, our conventional lending peers that make 30-year loans. Right. So that's one way. And so it's making sure borrowers bring in, a cushion, a down payment that gives us a little cushion between the home value today and what our loan amount is. And just the fact that we have shorter term loans that decrease our market exposure because of the time frame that we're holding these loans in. And so right now, what we're seeing in the marketplace, we're seeing home values go, it's still climbing a little bit, seeing fewer buyers in the market, but still very high quality borrowers. And we're still sticking to that 30% loan to value, just because, we may see prices flatten sooner than later, and then prices maybe start falling a little bit. So we're we're watching it closely, but there's still so much demand out there, especially for these bridge loans. But also, I'll go into some of the other types of loans that we're seeing and the types of borrowers. So we're seeing a lot of investor borrowers. The investor borrowers are out there buying a lot of different kinds of properties. Properties like multifamily, that some existing multifamily properties that need to be updated. The rental market, or people who can't afford to buy a home and need to rent. That's just growing exponentially, and that's sad. But across the country, the affordability rate for people to buy a home has, it's gone down a lot. So there's huge investments in rentals, and whether it's multifamily or single family residences. So we're seeing a lot of borrowers who have a track record of buying multifamily homes, anywhere from 5 to 20 million, or multifamily projects, and they're repositioning them for the marketplace. So those are loans that we're making. We have loan buyers for those. And then we have a lot of borrowers, and I'd say at this point, institutional borrowers, who are buying homes in bulk and, fixing and holding them. And, there's, again, not just in California. In California, the model doesn't quite work if you're an institutional borrower, because the home prices are so high. But across the country, we're seeing people buying homes, or investor groups buying homes, where the average home price is $250,000, and they're doing a little bit of rehab work on the properties and then holding them.
Okay. Hey, now I'm going to get to our last commercial trivia question. The pop band, the Bangles, would like for their fans to walk like what? Call 888-912-1190. First caller with the correct answer wins that tanning certificate. Stay with us. You're listening to The Best of Investing. Don't touch that dial. We'll be right back.
Yeah.
Welcome back to The Best of Investing. I'm Edward Brown, your host, along with Nam Phan of Pacific Private Money. Third trivia question. The pop band, the Bangles, would like for their fans to walk like what?
Walk like an Egyptian.
That's it. Very good. You remember the song.
Yay! 1 for 3.
1 for 3. That'll still get you in the Hall of Fame in baseball. Okay. So, give us some deals of the week. Like, generally, why are people going to Pacific Private Money instead of a bank for a loan? Because obviously, you guys are private money compared to a bank, so you're probably going to charge a little bit more. So why do people go to you? And deals of the week will probably help.
Yeah, so people go to us and other alternative lenders for a number of different reasons. Largely, though, a lot of it is just speed. I mean, if I could summarize it, it would be speed, and equally convenience, and also the other one would just be it's a loan product that alternative lenders and specifically for Pacific Private Money bridge loans that you just can't get, with a bank, right? So
Okay.
banks take longer, or it's just a loan product that they don't offer. So, with speed, because, why is speed a factor? Why can we fund loans faster? Generally because we're not, we're more holistic lenders, meaning that there's a certain amount of subjectivity or, besides the objective, numbers or black and white things like, is the value of the property really the value of the property? What's the borrower's FICO score? The other things are, what's the use of the funds? And we're rigorous in our own way, but we're not rigorous have to be rigorous like a bank where you have to check off all these boxes. It's more holistic. We look at the entire story. But depending on the type of borrower, if somebody buying a home, for their personal residence, largely the story is this, that they haven't sold their current home yet. So there really isn't a whole lot of judgment now. The question is, can they qualify? Can they afford to pay for our loan? And do they have a viable exit? And then for other types, like I was mentioning in the last segment, if they're borrowing in bulk to buy a bunch of homes that they're going to fix and hold, then it's just easier to work with a lender, an alternative lender like Pacific Private Money. So that kind of leads me into the deals of the week. One deal of the week really is multiple deals, but it's with one borrower, and it's a group. And they buy homes. They make offers on homes that are listed on the MLS, and essentially they're buying effectively all cash. They're using our capital to buy homes that they're going to reposition, meaning update a little bit and hold in a portfolio of rental properties. So as I mentioned in the last segment, sadly there's so many Americans here today who can't afford to buy a home and be a homeowner, and so that demographic is growing, and so the rental market is exploding. The opportunity for investors to acquire property that they can fix up and rent out is still really attractive, even with the rates going up a little bit or a lot. And so we had a borrower buy five homes from just off the MLS. Now these are the East Coast, and we provided the funding. Again, these homes are averaging like 250,000. So that's equal to one bridge loan in California, in the Bay Area. So it's like we made in aggregate $1.25 million loan. Those five $250,000 loans, so they can go out and buy 5 properties. So we're seeing more of that. And then the other deal of the week is just your kind of vanilla bridge loan, where still we have quite a few people migrating from San Francisco to other parts in the Bay Area. People moving out of the city for a lot of different reasons, but the homeless situation there is really not great, and so people want a different lifestyle for their kids. And remote work from home is pretty much a done deal now. I mean, we're seeing more and more of that, and I think that's going to continue to happen for a while. The cities still attract a lot of people, mostly I think younger, and then when they start to have families, I think they decide to move out. And because they can largely work from home, most employers now are giving that option. They're moving to the burbs, and so a deal of the week this week is burbs I would consider the Marin the burbs, I guess, when compared to San Francisco. But we have people, selling their very expensive homes in San Francisco and buying similarly expensive home in Marin, but using our bridge loan to fund it. So, as boring as they are, because we say, talk about them on every show, at least the ones I'm on, bridge loans are, they're every week we're doing more and more of them. And
you guys are going to do like a lot this year. I mean, you may exceed $1 billion, right?
We're, we're a private company, but that's not far-fetched. We're just really busy, and our footprint is going beyond California. We're licensed in Arizona, and we have expansion plans. We're doing a lot of what we call business purpose loans. So those loans I mentioned to investor borrowers who are buying fix and hold properties. But it's busy. And you have to apologize to some of our investors because they ask questions of us, and we're so busy sometimes it's taking 2 days to get back to them instead of 24 hours. But we're in hiring mode, so we what we need are more production staff in our main office, and we always welcome more investor capital because that's something we continue to bump up against is more investor capital. So want to pitch the Freedom Fund. We can talk about it and finish up on the next segment, but the Freedom Fund, if for our investors, can be a really attractive fund to invest in. We use it as a quasi warehouse line.
Yeah, I was gonna say, especially since there's no hold time, there's just a 30-day notice to get out, which is
right. I mean, there is a 12-month hold by regulation, but there's flexibility on redemption fees. So essentially, the Freedom Fund, on that email question of what do you do if home prices go down? The Freedom Fund, because it's so liquid every month, because we are funding loans and then turning around and selling them in 7 to 10 days typically, as an investor in a fund, if you have that sort of liquidity where you can redeem quickly, that can be very attractive. Plus, we're not holding these loans for very long. We're selling them within typically 7 to 10 days. So not a lot can go wrong with such a short hold period. And then it's an attractive return compared to, compared to sitting on that cash in a bank. So,
all right, audience, stay with us. The Best of Investing will be right back with some closing comments. Don't touch that dial.
Yeah.
Welcome back to the Best of Investing. Last time for today, I'm Edward Brown, your host, along with Nam Fon of Pacific Private Money. Nam, we had to kind of cut you off short in the last segment. Why don't you go ahead and finish off what you're saying?
Yeah. So essentially, what I was talking about with the Freedom Fund, and before that, the growth we're experiencing, that we've been experiencing for the last several years. We, if you're interested in investing in the Freedom Fund or any one of our funds, just give us a call. It's at 415-883-2150, or you can email us or go to our website, which is www.pacificprivatemoney.com. Or you can email us as well, which is info@pacificprivatemoney.com. And, with sort of the volatility we're seeing in the stock market with inflation, we are seeing more investors, pull out of the stock market or divest a little bit and parking it in debt, which is, debt investing, which is investing in any one of our funds. We saw this a couple of years ago at the beginning of the pandemic when the stock market, went down pretty rapidly. Yeah, I think there was a little bit of there's an overreaction of investors, worried that the stock market would crater. It didn't. It recovered nicely. But, we had people who were, anxious about the uncertainty of the stock market and invested, pulled money out and put it in the fund. And we're seeing that again. Our funds have produced steady returns. So, again, the other part of it too is, we are raising borrower rates on loans, in not in lockstep, but conventional rates are going up. So we're raising our rates. So over time, may see some higher returns in a couple of our funds than what people were getting last year, just because now we're charging higher rates. So, again, if any of our listeners are interested in the Freedom Fund, please do give us a call at 415-883-2150, or go to our website, www.pacificprivatemoney.com. And there's information there on the various funds we have, and also just our general, loan products, and just information about borrowing if you need to borrow as well. So, I think we actually have a number of borrowers who listen to the show and have called us and are, saying, oh, geez, I need a bridge loan. Actually, a number of our investors are. We're making a loan to one of our investors right now who is helping his daughter buy a home. And I love this stories when our investors call and say, hey, I want to pull some funds out to help my kids buy their home. Sure. Because, I'm maybe 10, 15 years away from that. And, it's always nice to hear parents helping out their kids, and kids these days really need that help. It's just so much harder, like we were talking about, being able to go out and buy a home, especially here in the Bay Area. So whether you're an investor or a borrower, it's worth at least giving us a call and learning more about our loan products and investment opportunities.
Okay, very good. Let's see here. Okay, you ready for our thoughts for the day? All right.
Yes, sir.
So my wife got me a jar of dirt for my birthday. I told her I appreciate the sentiment.
Yeah.
Okay, I thought you liked that. This one's actually even better. And I accidentally swallowed a bunch of Scrabble tiles. My next trip to the bathroom could spell disaster.
So do you have like a running list of all of these thoughts for the day?
Yeah, you know what? I get them emailed to me, and then I suss through them and pick out ones that I think are either appropriate or funny. Sometimes they're inappropriate, and I kind of go, no, not that one. All right. Well, I'm Lon again. Thank you again for joining us, as you always do, on The Best of Investing with some excellent information. And for the audience, tune in next week to The Best of Investing. We're going to be giving away more free prizes for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown, wishing you the best of investing. So long.
So long.